Welcome to our High Rock monthly video for October. Today, we shall look at how financial markets performed last month and what implications this has for your portfolios in the near term. We'll update you on any key adjustments to our models and special mandates and how the way that we manage risk first will be the key to maintaining growth in uncertain times. I'm Scott Tomlinson, and with me on the call is the founder of High Rock, Paul Tepsich, founded in 2010. We started our private client wealth management in 2015. And if you are interested in learning more, please visit our website at www.highrockcapital.ca. All right, so what happened back in September? Paul, gold and silver, really the story, right?
Well, you just skipped over the Blue Jays pretty quickly.
Oh, well, yeah, other than the Blue Jays, I'll pop back there because that's a pretty important thing right now, isn't it? But the Blue Jays in the playoffs, and as of last night, up 2-1. Let's hope that they're able to finish off the Yankees soon.
Yeah, hope so. Back to the markets. I mean, obviously, gold and silver starting to look like a hockey stick. And I think we probably have mentioned before, I mean, gold is certainly, and silver to a certain degree, but gold is certainly behaving like I think it should behave in this current fiscal environment. That being, we've talked about this before, how Western democratic nations are just running massive current account, fiscal deficits, and in many cases current account deficits too, but that's more on a trade basis. But these fiscal deficits destroy purchasing power in each country and destroy the fiat currency, if you will. And gold seems to be a recipient. I think it's interesting too that, gold seems to be acting more as a safe haven than government bonds used to, or even the US dollar for that matter. So I think that's what's going on with gold. Now, well, we'll talk further about any
Yeah, we're going to
change.
cover we'll
Yeah.
cover the risk factors that are up there. So we'll definitely continue this conversation a little further into the program. But we can see that over the course of the first 3 quarters of this year, it's pretty much the same story. Gold, silver leading, but international equities have and Canadian equities, global equities have been leading balanced portfolios into good, solid returns over the course of the first 3 quarters of the year. Morningstar's averages show us that this year, balanced portfolios should be up about 8.5%. So you can use that to compare to your portfolio. And if you ever want to have that conversation and understand further the risk that we utilize in managing our clients' portfolios, especially in the balanced mandates, please, we're always available to have that conversation. Scooting along, at High Rock, we are long-term stewards of your wealth. We're always available to discuss your strategy to make certain that it is keeping up with your goals and your tolerance for risk. And speaking of risk, Paul, let's jump right into financial market risks as they stand going into the final quarter of the year. Certainly, geopolitical concerns are one of the top priorities. Certainly, what's going on in Europe with Ukraine and Russia, cyber attacks intensifying. I think that's something that while I don't think we have underestimated that is likely the nature of future war. I think that it does present all sorts of potential shocks to the global system. I don't know if you have a comment.
Yeah, and maybe Number two, volatility in bond yields, as we were talking about. The reason gold is acting more like a safe haven as the US dollar and bonds used to tells you how much erosion there's been in the value of government bonds.
Yeah, and segueing right into number two here about policy uncertainty, certainly the high risk of or the high probability of higher risk being the highest level this century, with the U.S. government shutdown, the tax reform gridlock, and just what might happen with Fed policy down the road. I know that we're expecting one more cut the end of this year, but certainly monitoring the inflation situation is going to be of major concern for the Fed.
Yeah, for sure.
And that segues right into the next is the inflation issue. Some strategists warning of a second inflation wave if supply chains should falter as a result of the global tariff situation. We've certainly seen a significant move in the tech sector, mostly driven by AI and AI-driven valuations. So there's certainly a risk of correction, and with forward price earnings ratios at near dot-com levels, I think we have to be somewhat concerned. We mentioned trade wars, protectionism, and potential supply side disruptions. So I think we've covered the majority of what concerns us. Paul, I don't know if you have any further comments.
No, that's pretty comprehensive.
Then let's move on to our global equity model. Certainly, with the current valuation levels in global equities, our priority is rebalancing. So as we look through portfolios, we look to rebalance overweight, because what happens generally when markets rise, the weightings of ownership of the different equity classes that we have will be overweight. So we have to rebalance them back to even weight or slightly underweight if we want to be more defensive. So that's certainly something that we look at as we go through. One of the things that we have to be very concerned about is something called recency bias, which is a behavioral, financial behavioral issue. Usually what happens is investors become enamored with how well things are working because they've been working, and fail to understand that at some point in time we may get a technical correction. So it is something that as humans we have cognitive distortions where we overweight recent events or experiences when making decisions. So this is something that as managers of and stewards of your wealth, we have to try to avoid, and that's why we continue to rebalance portfolios on a regular basis. Paul, do you want to talk about the tactical model?
Yep. Tactical, we did one new addition in the month of September, which was a Canadian company that everybody should be familiar with, Lululemon. This stock got absolutely annihilated. I think it probably, I'm not looking at the high, but it was probably up around $550. We ended up adding a new position at $164, and it got down to maybe 159. But a couple things about Lululemon. Obviously, everybody knows the brand, and the reason for the downdraft, I think, is a multitude of reasons, but number one would be tariffs. So they have largely most of their clothing and products are made overseas. So they were hit with the standard tariffs. And number two, from Canada, they lost the de minimis exemption in the US. So I think the de minimis exemption alone was a $250 million hit. So when they reported their second quarter, a lot of this news came out, and what I would call, I think the board and management kind of quote unquote kitchen sinked and put all the bad news in to that second quarter. So, of course, analysts downgrade their expectations and future stock price, et cetera. So I think it's not. We only bought a half position, so unfortunately, because it did trade up, it traded down sort of after we bought it 164 to that 159 range, but it's back up around the 175. It got up as high as 180. So we will still look for a spot to maybe add to that position. This company has roughly $1.5 billion of cash and no debt. So it has a very, very long runway to figure this out. And having said that, on top of all the tariffs, they do need to two things. They had 23% year-over-year growth in revenue in China. So they need to continue to push hard in China. That will be their growth mechanism. But they also need new materials and new products to continue to innovate and drag in new buyers. So we'll look at that. One other thing we did was we sold our what was a core long holding in oil, which was Baytex Energy. Unfortunately, we sold it a little bit lower and popped up after, but as you may recall, back in July, we bought Baytex Energy bonds. So we didn't, obviously, we were planning on transitioning out of oil into natural gas at the time. So we still don't mind having some exposure to oil, but it's much easier to own these bonds at roughly an 8 3/8 yield. I think we bought them at. They are so much less volatile. They're just going to sit there because the company actually notified the street that they were holding back a bit and pausing their NCIB, their normal course issuer bid to buy stock back in the open market in favor of paying down more debt. So I think that was the right move. And we will, we'll just collect that coupon from that bond. And as I mentioned, we were looking at being more bullish on natural gas rather than oil. So not that it was in September, but just yesterday, October 7th, we ended up initiating position, which we've been looking at for a while. And we do own the bonds but the bonds will be called in they're 9 months. I mean, they could be called any time at par. Is New Vista, which is a Canadian nat gas condensate producer. Actually, I'm meeting with the company tomorrow, in fact, at a high yield conference, as I do every year. So we bought this stock yesterday, and I think it's got roughly 25% or so in it to the upside. So we'll hold that for a little while here. So that was a rotation kind of out of oil and into more natural gas and less volatility for the portfolio. That is about it for the month of September. I will say, Scott, when we looked at the chart in gold and silver, we did again in October, just yesterday, we did trim a little bit of our physical gold and silver holding through the fund CEF. We trimmed a small amount out. Gold is a commodity, and we've seen it volatile to the upside over the last little while, and I think it's got good fundamentals behind it, but it is a commodity, and it can be extremely volatile. So we're just rebalancing a little bit and took a bit off the table. And that's it for tactical, and I did go into October. I apologize.
That's okay. The rebalancing is an important aspect of what we do here. So it's good to bring that to our clients' attention. Anything to add? from the fixed
Yeah,
income
no,
world?
very little to add. I'm just going to say that all four sectors of that pie chart added value across the month. Say 10-year yields were lower by about 20 basis points across the month. So lower yields, higher prices. High yield performed well. Investment grade, typically when I can tell you spreads continue to compress or go lower, which is prices up in investment grade across the month, and preferred shares were stable to up a little bit. So they all helped add to the performance like across the month.
And is that bringing you to add anything with regards to our special mandates?
Special mandates. Yep. Preferred shares, yeah, reasonably stable across the month, as I just mentioned. We continue to get redeemed. Fairfax, a preferred share that we owned, was redeemed at the end of September. We are holding about 30% cash in that mandate, looking to redeploy judiciously, not in a rush. But that continues to perform well as both banks and insurance companies and even some corporates who just announced today, like an hour ago, another corporate that we own a preferred share in, but not the exact series that we own, is issuing a hybrid bond security, and they're redeeming a pref. So the supply of preferred shares in Canada, $25 listed preferred shares, continues to shrink. So that's really put kind of a floor under the value of the market. And high yield, just kind of steady Eddie clipping along. I'm probably sound like a broken record on this, but for those that are invested in that mandate, they know that's what we've been expecting to get, is what we call a good coupon year, i.e., we've got our portfolio, and we're not really doing a lot of changes in it because we're pretty happy with the weight. It has a high energy weight. For those that want to know more about that, feel free to contact me on why we own such a weight in energy bonds. But they continue to perform, so we're just clipping along pretty well here. I think that's
Excellent.
about it for those two.
Excellent. Excellent. Thank you for those updates. And that's it. Thank you all for taking the time out of your busy schedules to join us. We will be back with our next update at the beginning of November. Until then, on behalf of my colleagues, Paul and Diane, we want to wish you all the very best.